Hey there. Let's see. All right.
Hydrocarbon indicators. Any, somebody call, no,
No, I just started the recording. I forgot to record. I'm
oh,
recording.
okay. Um,
George is on here now. Jeff, George, you're
Yeah.
here?
Muy Grande to the west.
Do it.
Here's a type log from that particular field. These are the UW1 through UW4 sands that produce. They were great, again, great reservoir rock quality. And one of their better wells is from, they call it the Hennet 7 sand. UPR called it the UW17. It's called the Gruy sand, but this is the well that's produced 34 BCF of gas to date. And these are the sand thicknesses. Here's 80 feet of net pay here. This is what we're hunting. This is the decline curve from that particular well. 1989. So first 11 years of production, it just ripped. Kind of. Some of these wells will flow 10 to 20 million a day, cubic feet. Another example of an analog showing the sand thickness and its presence. 20% porosity. This well came in, and from this Hennet sand at 10,000 feet, 4.4 million and 56 barrels of condensate a day. Here's a regional line that goes from our Geronimo play. Again, there's that here. This is that high fold prospect, the reprocessed data set. And it ties this ties Destino Field 9 miles northwest. And where the stars are, where the production is in those two fields. And when you correlate seismically down dip from the top of Wilcox down into the basal Wilcox, you can see this entire section. And you're coming back on this huge structure to the south. That's on probably a diapiric type structure. But none of these fault blocks here at Geronimo have been tested in the Wilcox.
Hold up right there, Tony. I want to give this a little bit more explanation here for everybody. This is an impressive slide, by the way. I mean, the blue lines that you guys, George and Quentin and Jeff, following from the left-hand side of this slide, that blue line, it says T/WX. That means top of the Wilcox, which is our primary target zone. As you see, going from left to right, those black lines there are your fault lines, and that's your displacement. And each of those creates a container that fills with hydrocarbons. And that displacement, the more displacement you have, the larger volume that can comprise that container. And if you follow from left to right, if you put the pointer out there, Tony, all the way over to the right-hand side, right there, you can see those fault blocks moving. And there's as much as 2,000 feet of displacement from top to bottom. And so what you're looking at there, if you were to take all the rock off the top of that and look at it, you'd see a small mountain created, which contains the oil and gas. This mountain is 6 miles long by 2 miles wide and is this much thickness, up to 2,200 feet. It is enormous. It is massive. So this is perhaps to me the most impressive thing that I can see. One of the most impressive things I see slides that Tony put together here. So anyway, I thought I would put that out there, that this is really phenomenal. Anyway, go ahead, Tony. I'll let you.
Oh, you bet. Yeah, this is my slide deck. This is typically what we supply to the industry for participation, but a couple blow up of what the seismic looks like at Muy Grande and over Rosita. These are two analogs here that showing that particular, what the field looks like from a seismic standpoint. Well, mapping view, in the map view, this colorful slide is at the top of the Wilcox, or first hit at sand, I call it UW1. And there's scale here on the bottom. So yeah, this is 6 miles long from the northeast to southwest, and it's divided into two closures, one big closure to the west and a larger one on the east side. We actually want to drill, I think we're going to drill the west side first. We could drill the east side, but to get all the sands captured, we'd have to drill a directional well. And on a deep geopressure test, we're thinking both look great on, in terms of reserve potential, but we're thinking maybe do the vertical one first, and then we're off and running. We've got 8 to 10 development wells to drill on 320 acre spacing here, which is really exciting. The locations here, we've got X and Y's picked for both the west side and the east side of this. Upside potential on the first test is 30, 40 BCF of gas, similar to the best fields along strike. Next slide is again up at the upper, well, this is UW3, or the third Hennet sand level, which is the green here, UW3. And that's the vertical well we want to drill first. One of the big reasons is it's crest. Not only can we capture a number of Hennet sands in this fault block, but we'll cross this big down to the northwest fault and get into the UW17 section, which on our analog field at Muy Grande, it looks just like this. That's what the logs look like at 80 feet of net pay. And again, these are high flow rate wells, 10, 15 million a day, but beautiful, beautiful rock quality.
Okay, so right here, this one zone, is this the well or the zone did 34 BCF, Tony?
It's just this one well. This
Okay,
zone,
that one well, that's 34 BCF, and so that's 34 million thousands. So your gross amount that well made at $3 gas is about what, $100 million?
well, you got to multiply it for $4 gas right now.
Well, I know, I'm being conservative. So about 120 million at $4 gas. So that's what that means in dollars.
Mhm.
So you're spending $10 million on a well, and your gross result from that one well is $140 million at $4 gas. So I just thought I'd kind of keep everybody kind of point out what that means, is what these numbers mean is kind of important. Go ahead, Tony, sorry.
Yeah. Yeah, this is an ARB line that goes through both locations and showing both closures. Now, we used Deborah Sakery and to do the AI work, and this is her work. The seismic we reprocess is on the left side. This is Tricon pre-stack time migration. And she did her work with machine learning. Well, what is machine learning? Number one, she's been doing this for 10 years. Number two, she's hit, I don't know how many fields, but her track record is now 90% success rate using this software. She actually wrote the code for one of the companies that developed this software. And when she ran it on this play, everything highlighted in yellow. This is highlighting. I need to put the yellow here on this side, but it's lighting up. Anything with yellow streaks is sand. She can measure the sand thickness and subaerial extent, and she's showing all these multiple plays here on a dip line. And here's one of the zones, the UW3 zone that I mentioned earlier. She can map these, what we call geobodies. It's like an MRI of the Earth, basically. And she could see the subaerial extent of these reservoirs, both in a strike and a dip direction. This one reservoir here would yield, according to her volumetric calculations, using the porosities and permeabilities established by the offset producing field. So it's grounded in the reservoir rock qualities that have been recorded in the wells, good wells in these other fields. So she's saying at this one UW3 level, we drill a well right here or right here, you know, it kind of the yield on it 7.4 BCF of gas, which at times $3-4 is, you know, gross is 20 plus million bucks. And we could go in and map this, and we do see what we call amplitude anomalies that we can convert back to volumetrics. This is typically how I've done my work in the past and how most of the industry has done their work without machine learning. And I would have said, well, there's 200 acres of high amplitude closure at the UW3 with 30 feet of only 30 feet of pay and 200 acres in recovery factors. That's 8.4 BCF. Well, she's saying same play as 7.4. So we've got pretty good agreement between her software and mine that I've used in my career. Also, these are some of the ingredients explorationists like to see on wildcat plays. This is a wildcat, there's no doubt about it. But you got an amplitude that's conforming to structure. What does that mean? The oil and gas is concentrated at the peak of the structures, and that's what you map on. And you got to see this big enough to warrant the economics to drill a well out here. Here's another UW4 zone, same thing. We're seeing a strike-oriented depositional system on this one zone, a 7 BCF at that level. And it goes on and on. When you map these individual reservoirs, they conform the structure. They have hydrocarbon indicators. UW5, same thing. You know, we're looking at anywhere from 3 to 7 BCF per zone. So when you start stacking these up, right, you got 3 or 4 7 BCF reserve levels, you're suddenly, up in that EUR range of 30 BCF. Now we can't produce 7 zones. We have to go maybe 2 at a time. But when you hit a well with 7 zones, all of a sudden you start to put your development wells in place and really ramp up the production exponentially on these prospects. Here's just a regional strike line over this closure, and again showing the amount of relief, vertical relief, which again is 1,000 feet at the top of the Wilcox and 2,000 feet near the base. Huge structure. And that's bored out by isopachus thinning. We're showing the thinning of the structure on the crest, which is similar to the analog fields. Again, going back at northeast Thompsonville, there's that 40 BCF well. This field has 550 feet of column. And we're looking for something in that same order. This is a fault juxtaposition cross section, just showing we've got a faulted structure here. So you've got up thrown and down thrown sides, and you always want to try to pick a play where your sands are juxtaposed against shales, not other sands, which would lead you to believe that geologically you had good trapping characteristics. And that's what we're seeing here. The west side closure, very similar scenario. We have hydrocarbon indicators. This is the work I did with Tricon Geophysical in Houston, and they were we indicated that we have multiple stack pays with what they call class 3 AVOs lighting up on our seismic between the near and the far angles. Gentlemen may not be familiar with seismic and all these hydrocarbon indicators, but this is what you use. This is what Exxon would use to develop a play in the Gulf of America. Again, the west side closure here. We'll probably drill this well first because it's vertical, But down in that UW17 interval that will penetrate high side on here, we see a 685 net acre closure. And I only use 40 feet of net pay, but if it's 80 like the analog field, you could put 100 BCF in this. But I'm trying to be conservative. This one zone could yield 50 BCF of gas. The amplitudes also on this feature are magnificent. In the AVO signature on this UW17, covers 385 net acres. Again, here's some of the AVO work where you've got an increase in amplitude from near to fars, which is a direct gas indicator in the subsurface.
Okay, so real quick, amplitude is a measurement of the sound waves as they go through the earth. They slow down when they hit gas, and that's a measurement that we call amplitude. And the greater that amplitude, the greater the incidence or likelihood that what you're looking at underneath the ground is hydrocarbons. So that's what he's talking about with regards to amplitude. Just
Correct.
AVO is also a measurement of amplitude in another function. Yes.
Yeah, that was the UW17, and vertically above it, here's the UW2. Again, we're seeing a nice large closure here where we're going to drill. In the AI software, that's showing it 8.7 BCF just for this one UW2 horizon, which is vertically above the deeper 17 horizon. And we're thinking if we had 4 pay zones here in that conservative estimate in the deeper, we're looking at a well that could easily make 20 BCF of gas plus condensate. The other beauty of this play that we noticed is that up shallower at the Queen City level, 9,000 feet, which is non-geopressured, there's a bar sand, looks like a offshore bar, kind of like Galveston Island, right here. That's again, that's probably about 5-6 miles long and a mile wide, or almost a mile. But we're going to see that zone on the way down. It could offer some nice shallow potential. We're looking at 560 acres and 30 feet of pay could give us 20 BCF of gas up there. Again, that shallow zone has strong hydrocarbon indicators. And there have been 2 wells drilled on the 3D in the Queen City, but they're both off structure. They drilled in the 1950s and 60s. Here's a well with 60 feet of sand. And that's the zone we see lighting up with hydrocarbon indicators. There's no pay in that well, no hydrocarbon indicators. That well on this map is up here, completely out of the zone that's lighting up with hydrocarbons. So yeah, another indication of the AVO. This is called a class 2 AVO, where you actually have a decrease in amplitude on the far offsets. It's just a classification, but that's typically what works in the Queen City at 9,000 feet in the Texas Gulf Coast. Again, the amplitudes in this interval, this covering about 1,100 net acres. So we've got some nice running room up in the shallower horizons. We originally were going to drill a directional well. Now we're going to go vertical, so I need to change this, Jim. But these are the horizons that you didn't, the U1 through U5, UW5 on the east side. If we drilled a 2,200 foot kick well, we decided because it's geopressured, you got to set 2 strings of pipe, and it's expensive. And it's a wildcat. The smarter thing is go in and drill the vertical first, where you have less drilling risk. So that's what we're going to do. We're going to drill this west location here. This is an AFE on the west and an AFE on the east. You add them up, the completed well cost on the west is $9.4 million, very similar on the east. But that's the cost, not including acreage. One thing we're gonna do that was not done by other operators back in the 80s and 90s that drilled in the area is managed pressure drilling. Because we're going through a real thick shale section between the Queen City and the Wilcox. So they use this managed pressure drilling where they drill just slightly at geopressure, not way above, so you don't stick pipe and you have problems. That's one of the things we're gonna employ. Here's our play and two pipelines, two interstate pipelines, Energy Transfer and Enbridge, one right over the prospect. So we've got really quick hookup for production.
That's Enbridge pipeline. Is that what you got on there? Yeah.
Yeah.
Okay.
Enbridge.
And that's an interstate pipeline, right?
Yes, both are. And they have plenty of capacity.
And that basically bisects the two locations.
Exactly. Yeah, we're less than 2,000 feet
Yeah.
or less from that pipeline. These are
Is
gross
Enbridge-
economics. This is on the east location, but applies to the west. You know, you're looking at maybe $12+ million with acreage costs and dry hole costs. But with a 40 BCF well at $3 gas, it's a 5-to-1 return. 4-to-1, we're looking at 7-to-1. The promote includes an eighth carried working interest after an eighth carried working interest through the tanks on the first well, and an eighth back in after payout. That's what Paladin.
Tony, I think your numbers were updated again, and they were better than that. It was a 7-to-1, and then we ran it again at $4 gas was over a 10-to-1. I'll have to show you mine because I don't remember what we did, but
well, yeah, this was from, well, these economics are actually about 8-9 months ago, but yeah.
Okay.
But on a field basis here, yeah.
There it is. Okay.
When
Well,
you drill out, let's say we've got 8 locations.
Gentlemen, 8 or 9 months ago, the price of natural gas was $1.50.
Correct.
Okay.
So yeah, that's like the
stone. And where it's at right now?
About 370, 365.
Yeah, let's see. 370, but it was $4 about 2 weeks ago.
Yeah, it was 414 last week.
Now, what did you say, Jeff? JP Morgan
JP Morgan came out a week ago. Yeah, a week ago. They're looking for gas to go up 40 to 50% from here.
Woo.
This year.
JP Morgan.
Yep.
That's quite a statement. Yeah.
Well, this is the kind of play you want to be in, where you've got multiple offsets. You know, you'll be drilling out here for next year and a half, 2 years, enjoying those increased revenue from the production out here. But yeah, it's huge. You know, with $3 gas, which is what this slide was calculated on, at 7-to-1 rate of return, $900 million gross potential. This is a big company play.
George, 2 years ago, natural gas was over $10 an MCF.
Yes.
Yes.
Well, I think we're staring down the barrel of achieving that.
Yeah.
With the we started supplying half the world with gas, like we're starting to.
Yeah, well, that and also all these new AI data centers.
Yes.
The demand for power and energy is going to go up 18% in the next year.
That's right. That I heard 2 podcasts. One of them said that right now, what we're producing and what we have in storage, we have every molecule of natural gas right now spoken for right now, and it's only going to get tighter. A lot of the gas that was being produced from these shale plays with hydraulic fracking, gas was a byproduct for oil plays, and a lot of that gas is kind of gone, and those wells are now oil mostly, and their tops, which were gas, are gone. So the gas cap on a lot of that shale oil is played out. So we've already peaked. And I think that's what JP Morgan was looking at, and a couple of their analysts. Go ahead. Sorry, Tony.
Oh, that's fine. I'll just show there's a analog example in the offshore Gulf of Mexico. Great white field, Upper Wilcox, faulted anticline structured similar to what we're seeing. Now down in the Gulf, this is actually under a layer of salt, but it's drilled out. It's a huge field. Chevron owns most of it. It's 230 million barrels of oil and 5.7 billion cubic meters of gas. They call it. They don't go by feet. They go in metric system, but that's an analog. Just to point out what the chance of success on. I mentioned Deborah's success is approaching 90% with her AI software, but even if you strip that off and you use the hydrocarbon indicators we have, and this was an analysis the American Association of Petroleum Geologists did a year and a half ago, they're showing large exploratory prospects in the world that exhibit the type of hydrocarbon indicators that we're seeing, has resulted in 67% track record in giant discoveries. So kind of impressive. Again, here's a little slide on the economics. This was future of natural gas, which supports the LNG. Well, our rig rate, yeah, actually our rig. This is our rig rate is going down, thanks to under exploration most recently. But the export capacity, there it is projected to really increase astronomically. And I threw this slide in, and Jeff, you could appreciate it. You mentioned $10 gas. Well, there's where it was. 8, 9, 10 years ago. It went from $2 way up, and we're sitting right here. So if you can imagine this point, even approaching $4 is about here. That's what's laying in front of us. And yeah, we got a really large reserve prospect that can, make you guys, I'm thinking 10 to 1 on your money.
Or more, yeah.
Or more.
So especially if you're drilling the thing out and
yeah, let's be a little conservative right now since we haven't started drilling yet, but
yeah,
that's good news.
Yeah, that's the good news. But that's the play. Jim may have mentioned to you, we've got a buyer for the remaining interest that they may close on shortly, but they haven't closed. They've been dragging their feet. So there's still interest open until they take the remaining interest.
And that meeting could be tomorrow. We'll see. But in any case, this is from the horse's mouth, guys. This is Tony's had this since the mid 1990s. That's 30 years, I think, by my math calculations.
Mm-hmm.
Is that about right? So
yeah,
this has been,
never drilled, right?
Never drilled.
And
in the meantime, all those other fields have been drilled and produced to the tune of 4.3 trillion cubic feet of gas plus condensate. I think that calculates out to about $22 billion in revenue if you calculate that at $3 gas.
Yeah. Isn't that about what the U.S. debt is? I think 37 trillion. I bet it's pretty close to that.
Well, yeah. Well, you got the Northeast Thompsonville field made 700 BCF, which is pretty respectable. That's about 2.3 to 2.4 billion dollars gross back. So if ours can do half that, which is about right, our structure could return a gross of about $1.25 billion. So 1% in this to start would be 125 grand per 1%, and you're going to end up with a portion of that that asset that eventually will have a gross value of 1.25 billion. Some of these wells that have 8, 9, 10 plus pay zones in them can last for 10 plus years. So the idea here is we develop a monthly income that comes to us that is substantial, that is significant and grows if we drill another well, add more and more to it.
And those wells should be less expensive as we go forward.
Well, yeah, the acreage is being is paid on the first well. That acreage is no longer needed to be paid. So well number 2, the drilling and testing portion drops by half. That's where the rubber meets the road. Is a much faster payout.
At the second well, we're looking at about 60 grand.
60 grand per 1% for the upfront cost per point. And then the completion would be the same. The completion is heads up at about 30,000 per point. That doesn't
So
change.
even on the second well, it'll still be 30 grand.
Yeah.
Completion.
Completed. Yeah. And that's the same on all subsequent wells, the second well going forward. So yeah.
So basically every dollar you're making in from the first well, you keep investing in the second, third, fourth.
Yeah, I mean, if you want to look at it that way, I mean, the dollars coming to
until you
you
own 7 wells, and that's when you start making real money.
Well, you're making money from day one that we get a distribution. It goes to you. If you decide you want to stay involved, then you write another check to be involved in well number 2 and so forth. And if you do that, eventually when you get involved, a lot of the dollars that you're putting back up are recycled from the first well or 2. So those are you're reusing the dollars that are basically coming out of the ground. So the idea here is that eventually you want maybe 2 wells online, and then that hopefully can pretty close to self-fund the drilling going forward of all the remaining 6 wells. So you don't have to come with new dollars. So what you're doing is you're using existing cash flow for expanding your operations. And as your operations expand, your cash flow accelerates. It's like building 1 restaurant, and then those 2 restaurants is enough to pay for building a 3rd and so forth. And pretty soon you're Starbucks, right? So, well, that's coffee, but it's about pretty good too. Yeah. So this would move obviously much faster. There has never been a time that I've seen things line up this well. But go ahead, Tony. I'm going to let you continue. I apologize.
Oh no, that's it, gentlemen.
Okay.
Hey, a lot of people say, "Hey, Tony, how come this never been drilled?" Well, one, because of what occurred historically.
Right. So if you had this well since 1989 or whatever you said earlier, why this well haven't? Right. Why it took so many years for you guys to get the well started?
Yep.
Well, George came in late, so you want to explain to George, Tony, why this wasn't drilled in the 1990s? If you could tell him.
Oh yeah, the company I flipped this to or sold it to, George, was Union Pacific Resources. They shot the 3D, confirmed the prospect, put it on the docket to drill. And 30 days before spud date, I get a call and they said, "Tony, I got bad news. We're not going to drill your well." I said, "Why?" "Well, we just got acquired by Anadarko Petroleum." And that time they were concentrating in the offshore. They didn't want to drill this thing. So the play, it just died on the vine. The lease is expired. And then, I guess early 2000, well, I'm trying to think what year it was, but when gas prices were down in this lower level, $2, $2.50, the economics on this play got really thin. And 2, this was also the period where the major independents jumped into West Texas and or the Pennsylvania Marcellus Trend doing horizontal. So it was never South Texas was never a exploration focus. for many years. But now that gas prices are coming back, and I went back and researched that this play had never been done. I got Paladin Petroleum to come in and put the play together, and it's been vetted by multiple companies already, gentlemen. So you can have anybody technically you want come on board and look at this, but and you're welcome to. But it's exciting, particularly for me as a generator, to finally get a prospect from 30 years ago drill, a big one, biggest one of my career, actually.
Probably the biggest and most anticipated one I've ever seen in my career. And so there's a lot of work that went into this, going back 3 years when I met Tony and Bill. The day I met them, they were showing me another project, and I saw on the map wall a map, and I said, "What's that, Tony?" He said, "Oh, well, that's the Geronimo." I said, "Oh, okay." I said, and I looked, and he told me about it. I said, "Well, I sure would like to do that." He said, "Well, we got a few years worth of work before we could even be ready to drill that one." And I think you were thinking it would be drilled to possibly to 16,000 or 17,000 feet. I can't remember.
Originally, UPR wanted to go deeper, but all the AI work said we don't need to.
So that made the prospect less expensive, more economical. And so Bill and Tim went out there and started leasing this acreage, 4,000 acres. And some of these parcels are 40, 60, 160 acres at a time. Imagine how many man hours it takes to go out and knock on people's doors 100 acres at a time to assemble 4,350 acres. So that's millions of dollars, hundreds and hundreds of man hours worth of work, 3 years worth of work to prepare this prospect to get it to drill. We're here now at perhaps one of the most amazing times. The stars are definitely lined up for this one at the right time. This has enough legs on it and enough running room on it to where you can make some hay here in a short period of time. It's quite a blessing we have it. So I'm sure Tony is, after 30 years, going to be glad to finally get some activity on it.
Yeah, Jim, I actually, when we were marketing this thing, hot and heavy, 6 months ago, I sent an email. I never got a response to Elon Musk, because this prospect sits 100 miles north of Boca Chica. So I basically said, "Hey, Elon, you need some natural gas to fire your rockets to Mars, and you want long-term reserves to supply that, give us a call." But
hey, Tony, the sheet that shows where is it Etheridge and Energy Transfer pipes run next to the site?
Uh-huh.
I don't know whether or not, does Energy Transfer's line connect to the other line?
I don't know that. I'd have to ask the operations guy at Paladin. Well, we can check on that. These lines were coming, out of deep South Texas and some of the larger Wilcox fields discovered in the 1970s. And I know they connect to Houston Ship Channel eventually, but I don't know if they're crossing.
Well, that Houston Ship Channel is where 15% of the LNG, at least, it might be higher than that today, but at least 15% of the gas, the LNG gas, goes on the ships in that channel.
Right.
Yeah.
Well, the way these pipes are displayed on this page, it looks like they intersect each other.
Well, they're two separate companies. I think they are, aren't they? Energy Transfer. No, I think
Quentin
they're separate.
would love to know the answer to that question, Tony. So if you
Yeah.
could find that out, that'd be great.
Yeah, we'll do.
Any questions, George, that you'd like to think of while we have the guy who originated this project? You want to ask him? There's no bad questions here, but yeah, we're gonna probably get started on this, and we've got some pretty high powered partners already in it. One of the largest midstream oil companies in the entire country of Mexico is a partner in this, I believe. I believe they're still in it.
Oh, yeah.
And then, of course, another partner as of possibly tomorrow coming in who has a pretty significant background and holdings in the industry. So this is it's certainly populated by some respectable people that know a lot about what they're doing.
Tony, I have a quick question, and
Sure.
that is, you mentioned the first well would be a vertical well, but you mentioned there might be possibility of some horizontal drilling in this field.
Yeah, yes. You don't want to, on a wildcat play, Jeff, you don't want to do it initially.
Right,
Because you want to get your exact depth of these horizons. But once we get the first well in and we recalibrate it, let's say the UW2 works on either fault block. And instead of, let's say we want to develop this UW2 rapidly and it may have 3 or 4 offsets. Well,
right.
You can come in on a second well and drill a 3, 4, 5,000 foot lateral. You can drill and stay right in this. If it's 40 foot thick, he's staying in 40 foot of pay is piece of cake. Once you have the exact depth, the dip meter, the 3D, if you stay in a zone like that for 4, 5, 6,000 feet, it's Katie bar to the dome. You could probably flow 40, 50, 60 million a day and eliminate 2 development tests vertically. So this offers that upside.
Thank you.
Yep.
Yeah, the key is to drill the first well, get the cash flow started, identify your geophysics with your physical exploration, and then from that put your game plan together with your new data. And so the first step is what we're about to take, and then it'll build itself. It's a small snowball sitting at the top of the hill, and we're just about to roll it off. So certainly has potential of becoming a monster, for sure. Any good question?
No.
Now, if the first well do end up being dry, do we have another chance of drilling another well?
I would say yes. I mean, you're going to test probably the east anomaly and the west anomaly, no matter what happens on the first one. Would you say that?
Oh yeah, yeah. You got 2 large closures here, and
Show them that.
Yeah, they're separate closures and they're on 2 different faults. So there's always a possibility of different migration timing, because you want to take your best shot first. So I have a hard time believing they won't both work. Of course, I'm a generator and I'm biased. But yeah, you've got a large closure to the west and a more elongate larger one on the east. So one won't necessarily condemn the other one.
Oh,
It'll
yeah.
piss off the people that participated in the first one. I'll be mad. But yeah, you've got two separate plays here.
Very good.
All right.
Thank you
Thank
guys
you.
for tuning in on a kind of a last minute deal here. I appreciate it. I know.
Yeah, this is literally the 23rd hour. So, but
Yeah.
I'm glad you guys could attend, and Quentin, yeah, you have my email address now, and you can be in touch with Jeff and George. We'll talk here a little bit later.
Sure.
All right, I'll give you a call here shortly.
Thank you.
Thank you,
All
gentlemen.
right. Yeah.
Take care.
Thank y'all.
All right, guys. Thank you.
You bet.
Yep.
Bye.
Bye-bye.
Thank you.